Hello and welcome to PTTV. Who wouldn't want to earn triple digit returns on one's investments? Small cap mutual fund schemes in the last 1 year have given up to 180% returns. Same time period, mid cap mutual fund schemes category has given up to 102% returns. While these kind of returns are attractive enough to lure every investor to get into them, investors must be wary of the risks attached. To guide us on the matter, we have with us Mr. Sunil Subramaniam, Managing Director of Sundaram Asset Management Company. For existing investors, he says, for those who have their goals 12 to 18 months away, must move their funds out to short-term debt funds.
So I would say there are two things here. One is that why did you invest? Second is when did you invest? Okay. So why did you invest? If you had a certain goal for which you invested, and that goal is going to come good in the next 12 to 18 months, right? Now, why is 12 to 18 months an important time frame from an investor's perspective? Is because the 2023 liquidity withdrawal or tapering, as they call it, right, will be discounted sometime in 2022 by the markets, right? So knowing that event is coming, there could be some volatility and uncertainty at some point in the next 18 months, depending on when the market reads it. So the investors whose goals are at that stage should not keep themselves at risk. After having worked so hard and your money has worked so hard for you, you can't at the last moment have a market correction and suddenly your dreams are disappearing. So anybody who needs the money in the next 12 to 18 months, I would say they should book the profit and keep their money in a short-term debt fund so that they are sure that for that expenditure, when it comes, they have the money. So outlook. So when you invested is the money. Why did you invest? Look for a goal. Then when did you invest is important because if you invested pre-COVID and during the COVID, so the pre-COVID investor would have seen the correction in March and now the market has more than recovered and done it. Now, if your time frame is more than 3 years from today, you don't need to do anything. You can continue to stay invested because there may be shocks along the way, as I mentioned, but after that, once the liquidity taper is absorbed by the market, it is an India story which is going to dominate returns, and mid and small caps benefit from domestic story, being good. So, in the case of mid and small caps, the reason for the recent rise is also important to note. See, what has happened is that FIIs largely invest in large caps, right? Then domestic mutual funds and domestic investors, they invest more in mid and small caps. So if you see that when the domestic participation increases, you will have a broader based rally where mid and small caps also participate. So if you see now the trend over the last few months is that domestic investors have started again giving money to mutual funds. SIPs are growing every day, every month they're touching a new high. Then for the next few years, you will see that domestic inflows, when they support the market, you'll see mutual fund managers will buy large, mid and small, all the three. So I would say that the investors' outlook in terms of time frame is what should decide whether you stay invested in mid and small cap. Though there has been a strong rally, if your view is 3 years plus, then I would say that you will still benefit by staying invested despite the current high valuations. Only in the next 18 months, if you feel that you need the money, then you please try to park it aside in a debt fund, short-term debt fund.
And what about new investors? Should they get in now? Because looking at the triple digit returns, these two market caps are supposed to attract new investors.
Yes, that is the biggest problem that people chase past returns. So if a new investor comes, he will look at the small caps giving more than 100%, mid caps giving 90 to 100%. So they will get tempted to put too much of their money into small and mid caps. So I would suggest for new investors that you better choose mutual funds. Number one. Number two, you choose the SIP route, right? Where you stagger because there is going to be volatility. And third is, I would say, choose flexi cap or multi cap funds, which allocate to all the three cap curves. You see, you can't predict which is, what goes up must come down, what goes down must go up, is a mantra of the market. So flexi cap and multi cap category is the best for new investors who can, through SIP route, they do, the fund manager changes the allocation based on the valuations, right? So he will take care of that burden for you. So for new investors, I would say that's the best way to go. Flexi cap, multi cap, SIP route, and having a time frame of at least 3 to 5 years when they initiate. Then you don't need to worry about current market size, because all of this will get taken care of.
And looking at the current valuations, what should investors add to their portfolios right now?
So I would say that, see, in India, this suddenly you're hearing this value stocks are going up because they've been beaten down. I would say these are all a liquidity-driven bounce back rally, right? I think one thing important, very important from an India perspective, remember, is that India is a growth country, right? So for India to reach a true value status of stocks is a long time away. So in India, you have to buy growth, but there are two types of growth. There is growth which is known, like you know that this consumption is going to grow, right? So everybody buys it, so valuations are high. And then there is growth which is not so certain, like cyclical stocks, like cement, industrials, those kind of stocks. So the blend between growth, and I would like to call this second category not as value, but growth at a reasonable price. So growth which is not yet known properly will be available at a reasonable price. So very often people mistake that for value. No, it is only that there's unknown yet. So when you split your portfolio between growth and growth at reasonable price, the IT sector, the consumption sector are all those which are growth, because you know the growth. The transparency of the business, how they do their business is known. So there are no room for positive or negative surprises. So they give you stable returns. Though the growth is high, the PE ratio is high, they still give you stable returns because there is consistency of their performance. Whereas when you take cyclicals like industrials and building materials and all of that, there they go through cycles. So there, this price, to find the right price, there when the P ratio goes up, it means that it's likely to come down. So there you should exercise that valuations. When you look at cyclicals, you look at, don't go by the past returns. Instead, you should actually play contra and say if the valuations are very low, then if you hold for a 3 to 5 year period, definitely a time will come when the valuations will peak.